Two large cap stocks defied gravity when world over stocks were falling as if there was no bottom. An investment of rupees 1 lakh in any of these two shares would have grown to around 5 lakhs in 10 years. In the long term, both of these shares have outperformed the return of benchmark Nifty. Besides the impressive returns, there's a crucial reason why these stocks should be in your long-term portfolio, which I'll reveal at the end of this video. Stay tuned, I'm sure you'll not want to miss it. Hi everyone, I'm Vineet Jaiswal. Welcome to my YouTube channel. If you're interested in technical analysis of stocks, make sure to watch until the end. Through this video, I aim to share my perspective on the stock market and not provide specific tips. Please note the information shared in this video comes with certain disclaimers, which I'll detail at the end. Today we'll analyze the chart of two FMCG giants, namely Nestle India and Hindustan Unilever. The promoters of both these companies have a global footprint. Their products are regularly used by most of us, and the brands are household names in India. Both have track record of consistently creating wealth for the shareholders and outperforming the Nifty 50. Let's start with Nestle India. Before I analyze the chart, let me share an anecdote with you. Back in the 90s, when I used to work in a reputed stockbroking house, a colleague of mine had told me once, "The day you stop eating chocolate, sell Nestle." Well, I would have said, "The day Indians stop eating Maggi, sell Nestle." It's not about chocolate versus Maggi. The message is loud and clear. There are some stocks which one should not consider selling unless there's some compelling reason. In fact, both Nestle and Hindustan Unilever are such stocks. Now let's look at the chart of Nestle India. We can see that Nestle has been on a long-term uptrend with occasional sideways movement of price or sometimes price correction as well. Since 2014, it has delivered a CAGR return of nearly 16.8% per annum, excluding dividends, whereas Nifty during the same period has given a CAGR return of 14.6% per annum. The hallmark of Nestle's uptrend has rarely been eye-catching, but the overall return has still been quite impressive. Since around October 2023, we can see price consolidation, and it seems Nestle is preparing for the next major move. Once it comes out of its price consolidation, the next probable target on the upside could be around 3,300, which is nearly 32% above the current price. However, please note this is not a guarantee or a buy or sell recommendation. Next, let's move on to the chart of Hindustan Unilever, another FMCG giant. Before I speak on recent price action, let me show you the price movement during 2000 till about 2010. The price was trapped in a very tight range, barely giving any return during this decade. I'm sure many novice investors would have sold during this period after losing their patience. Here's a pro tip. After a long period of price consolidation, one gets to see a period of extraordinary bull run in shares with proven track record. Now see what happened after 2010. We can clearly see that Hindustan Unilever has been in an uptrend for the past several years. Since 2014, it has given a CAGR return of more than 17% annually, again excluding dividends. After making an all-time high in September 2021, the price has again been trapped in sideways movement. And this month it seems to be breaking out of this price consolidation and has made a new all-time high. If the price breakout sustains, we'll witness a new bull run. In such a case, the stock might target 3,900, which is nearly 36% above the current price. Again, this is not a guarantee or recommendation of any sort. As promised, here's why these stocks are essential for your long-term portfolio. During the March 2020 COVID-induced market crash, when the Nifty fell 23%, Nestle India and Hindustan Unilever bucked the trend, ending up 3% and 5% higher respectively. In the 2008 global crash, when the Nifty plummeted 52%, Hindustan Unilever rose 17% and Nestle was only 3% below its previous year's close. These stocks have time and again withstood the market turmoil, making them strong candidates for hedging your portfolio. Thus, they are excellent choices for regular SIP investments or accumulation on dips. With that, I'll now end this video. I hope you found this analysis useful. Please extend your support by subscribing to my channel in case you haven't. Also, kindly hit the like button and share this video with your friends and relatives. In case you have any comment or query, let me know in the comment section below. Thanks for watching, and I'll see you in the next video. I'm not a SEBI registered advisor or analyst. This video is only for educational purpose. Stock market investment and trading entail risks. It is advisable that you should do your own due diligence and analysis before investing or trading. Discussion about any share or other forms of investment during this session is not a recommendation of any kind, and I may or may not have positions in such investment or shares. Past track record is not a guarantee for future performance. Information, stats, research results shared during this session are not entirely mine.